Hello again. It's now my pleasure to introduce the penultimate session of the day on liquidity, another one of those mainstay topics, along with collateral, which we discussed this morning, that will, I think, be a feature of securities finance events forever. Anyway, we all know the value of liquid markets. We also conversely understand what can happen when liquidity dries up. Securities finance clearly can provide the transactions and the mechanisms to help with liquidity, but these markets themselves are challenged, and I think we're going to hear more about what those challenges are and what's being done to overcome them next. I'm not going to delay any further because we've got a very lively group of panelists lined up for this next one. So without further ado, I'm going to hand over to our moderator for the session, Gabriele Frediani, who's management consultant at ZBO International. He's going to introduce the panelists and lead the discussion for us. Over to you, Gabby.
Thank you very much. But how can you say that? How can you compare liquidity to collateral on a securities finance? I don't know how we're going to live with this. Yes, it's that moment of the year where we have that panel on liquidity. Last year, before I introduced my distinguished panelists, in fact, I'm looking at them thinking, poor Bill Foley must be in a state today. He's never got this kind of lineup. But anyhow, before I introduce you, a year ago we had a panel on liquidity, and as we said before, there's always a panel on liquidity. And last year the angle was the use of assets versus inventory. We moved on to usefulness, maybe touched a little bit on workflow. We looked at drivers, and in the preparation of this call, I must say that we covered a number of those topics, but realized that this year has been an absolutely exceptional year for the liquidity chain, and that's why we changed the name. But that's me talking already too much. Before I actually introduce my co-panelists or my panelists, just a little thought for one of our good friends. So I'm just sending a little message upstairs to my friend and our friend Jim, who after every one of my panels will always send me something very nice. That's the kind of guy I was, because it didn't really deserve those kinds of comments. I will move on now. So let me first introduce our panelists, or let them introduce themselves. Introduce yourselves. I think everybody knows who you are. So I would like you also to point out what you've been working on this year, and I think for some of you it's been a particularly interesting year. Staffan, please go ahead.
Staffan, you're on mute.
This is the first time Staffan does it.
It's the first time I do one of these events, so I do apologize.
They don't call him Young Staffan for nothing. Staffan, all yours.
First of all, I echo the kind words are said about Jim. He's sorely missed, and one of the favorite quotes, he lived every day like it was a Saturday. He really lived life to its full when he was around. So we have all very fond and happy memories around that time. To go back on the topic, a year has passed, and it's a lot of things has happened in 1 year. My name is Staffan Ahlner. I head up Collateral at State Street, and that's one of the changes that we are looking to do here at State Street is to trying to work on or try and implement more tools to the buy side and add more counterparts from a trade and a post-trade perspective into the buy side. The regulation, which the previous panel was talking about, the UMR side, is really forcing the buy side into the collateral side. Many buy sides have been there already. What we are working on and instead setting up is the establishment of the tool set from a trading and from a post-trade perspective to enable the collateral treasurer at a buy-side community to access the ecosystem. So with that, I'll stop there.
Thank you very much. Grant. So for those who don't know Grant is a newcomer in the business, been around now for 30 odd years. Grant, all yours.
Thanks, Gabby. I'll doff my cap to Jim Algier as well. So worked with him, knew him a very long time. It's our market lives with personalities, and that's how we thrive and survive. And he's a big loss, I would say. So let's see what have we been working on. So I run sales in EMEA for EquiLend products. Look, I think it always surprises me how new participants keep coming into market. We lose some old ones, and I think we had some announcements today of people stepping out of this market. But at the same time, people still evolve. This is probably one of the most interesting markets to be involved in, full stop. There's a lot of change going on. And with that, it just means new participants extending new access to our market, which, like you say, historically has always been probably very closed. I think that's opening up, and I think that's what Staffan just mentioned, is how he's looking at that, opening up that market. But you've got things like blockchain coming, tokenization we heard earlier on, and things like UMR and how we start to connect those components. But with that, I'll stop for a minute.
Thank you very much, Grant. BJ, the floor is yours.
Thanks, Gabby. And I echo the sentiments around Jim. He'll be really missed. So thanks for having me. My name is BJ Marcoullier. I head up sales and business development for Transcend. Similar to some of the sentiments echoed, it's been a really busy year or so. And really across a number of fronts, both from a client perspective and engagement perspective, but also from a Transcend perspective. And just some notes, just for, I know we have a lot of international folks on the call. So just some of you may not be aware, we've opened up our office in London, which is getting headed up by Raj Patel. Some of you all might know, back from his days at Morgan Stanley. And we also have Patrick Tessier, who used to run clear derivative operations for Citigroup. So happy to have them on board and actually get some boots on the ground in the UK and Europe. But really what we've been seeing a lot of is like working with our clients, and a lot of our clients are actually going through some really significant transformations, right? And transformations not only from a technology perspective, but really thinking about how they're organized to meet some of the challenges that we're going to talk about, obviously, as we go through this session. And really those challenges are around, are they well positioned and organized to scale when it comes to addressing these challenges about liquidity, collateral, funding, really, and risk for not only themselves, but for their clients as well. So looking forward to digging into that a little further.
Certainly. Thank you very much. And last but not least, someone who's done a couple of panels as well. And David, the floor is yours.
Thanks a lot, Gab. I will obviously echo everything you guys said on Jim. I started my career in 1996 at Paribas, working on collateral management at that time. And well, Jim has been one of the first guys I met, was with Bank of New York at that time. And I kept having very regular business relationship with Jim. And I must say that it's very rare and unusual to cross the path with someone who is as kind, as nice, and as professional as Jim. So obviously it's been a shock, and I will share it with all of you. As far as I'm concerned, well, I'm David Raccat. I've been working 20 years at BNP Paribas, co-founded Wematch back in 2017. So it's going to be now almost 5 years that the solution is out there. And I'm running the company here in EMEA out of London. I think that the topic of the panel today is going to be super interesting for us, because we were talking about it amongst ourselves, preparing for the flow of questions, and we ended up talking about the flow of liquidity. And I would say that as far as we're concerned, we've started to launch the company by looking after the trade and the liquidity, thinking that the liquidity was started with the trade. I think we've now came to the conclusion that the most important is the workflow, and that the most important is to deliver everything which is about and around the workflow to make our users' life easier and more let's say efficient. So we'll stop here as the intro, but I guess those are the topics that we will probably develop during our discussion.
Well, that's certainly, thank you very much, David, and a big year for you as well in terms of a round of funding, for which I am really sincerely very happy for you guys. So you mentioned you mentioned the change in sequence in terms of workflow to liquidity and liquidity to workflow, or the other way around, or vice versa, or reverse. But we'll talk about it later, so I won't spoil it for anybody else. But we have actually changed the title of what was probably Justin Lawson's The Liquidity Panel into the Liquidity Chain. Grant, picking up what you said earlier, there's some participants dropping out. There are more participants, or is it just about more participants being active? So in fact, I'm going to start with Staffan, because Staffan, you made a point during our prep course saying this is still a long chain. We know who's on both ends of the chain. There's drivers which are regulatory drivers, and there's business opportunities, and we'll leave that where it should be. Many links, many relationships. So you have quite an ambitious mandate to actually go peer-to-peer. Floor's yours.
Thank you. And yes, it is a division mandate, which Travis is really running the Keltner on our side, running the trading side, and I'm looking after the post-trade. As a team is exactly what David is talking about. We need to look at this as a complete end-to-end flow. And if we're looking at the ecosystem right now, it has changed massively since the 10 years that the industry has been fairly active. But it also, we're looking at some of the events that happened that requires, from our perspective, the need for more participants coming in. We do have crunches in 2019, September. We did have the US repo rate hiking up to 10%. And it just showed that there was didn't matter what the price was, the trade didn't happen out there. And so those kind of signals is where we need to look at the ecosystem in the chain and add more links to the chain to ensure that we can fully operate, and also strengthening those links in the chain to ensure that we are working full out in all the capabilities. The various avenues that people are accessing funding, and being it through the repo market, the TRS market, and the lending market, that more and more avenues to access the funding as well. So we can't just look at liquidity in the isolation. If you are looking at the three kind of large collateral markets, with derivatives being one, lending being another one, and repo being another one, they're all interconnected one way or another, and those tools need to be able to manage, and they are. One trade can feed the other trade to be able to transform one asset to another to reach that liquidity. And it's that tool set and that workflow that we believe is very important for the client, and particularly on the buy side when they're coming into the market and getting it, interacting with the market. And there are great partners out there to work with them nowadays compared to 10 years ago, in helping people getting access, help them with SFDR reporting, help them with the price discovery, help them with the post-trade settlement, mobilize asset and optimize assets as well. There's actually so many of them out there that is a question of consolidating that and getting that connectivity, and that's where we're working with our client and prospects on making that connectivity and establishing those collateral treasury connections.
I heard the term help them a number of times, and I'll pass now the floor to you, Grant, because you actually mentioned how exciting the space is. You guys have, I think, EquiLend's been around for 20 years. Just guessing, considering the background behind you. So how do you help? How do you bring these new participants, or these formerly passive, now active participants into the fray?
We've just broke through teenagehood, effectively. Yeah, so still the beginning, hopefully.
That's a bad image.
So I mean, I think the key point is, if we don't make people's life easy, they can't access these markets. And that's the same for the guys who participate in the markets already. Yeah. So regulation has driven change, and that's positive change in lots of ways. SFTR did it. I'll move on for that. I won't spend too much time talking about it, but it did a lot of good things. CSDR is coming, and I'm not going to spend too much time talking about it, but it is important to reflect the fact that things such as CSDR, our market has such a broad impact on the capital markets, full stop. And we need to make sure we get these things really right. Otherwise, you know what? It has effects on our pensioners, spreads widen in the markets on securities that people are making markets on. The capital markets need to operate, and operate efficiently. And this invisible market that my family probably every now and again say, so what do you do again? Is incredibly important to function and function well. So, and I think the CSDR is probably the broadest reaching change to our market for a very long time, and changing some of the ways that we perform and our clients communicate. So we do have to simplify connectivity. I mean, we did it 20 years ago, but there's still a lot of things that need to change. We talk about client infrastructure, which is complex and different for every institution, but centralizing process, connecting technology is the first step. But I said earlier on, I said new participants keep coming on, whether that's peer-to-peer or whether that's enabling the fact that people can continue to be part of the chain of this market. I mean, you've got the tier 1 banks and institutions, you've got the tier 2 that trade with them as well, but then look at the end effect of that process and the impact on liquidity of hedge funds, etc., when they access securities lending and they access financing. We do need to ensure that this is easy to access, easy to transact in. So, you can trade your own retail purchases on a number of the retail platforms, and actually, that those securities can be lent within this market so that you can get an extra yield, and this market can benefit from the fact that there's just a wider pool of assets available. There is a ton of liquidity out there. Yeah, and providing access to that and simplifying that chaining process of how that liquidity passes through is incredibly important. It's something that we focus a great deal on. Honestly, and I'm not going to spend too much time, it's not a sales pitch, but we've launched an awful lot of new products this year and last year, and it's because of all of those components where it's really important that we understand and connect. I mean, yes, we've been doing it 20 years, but we're not complacent. It's not saying our job's done, but it's far from done. Clients are challenging us all the time. This market is evolving an awful lot on a regular basis. So, and there's more to come, tokenization, blockchain, etc.
But that certainly puts you on cue, BJ, because we're talking about bringing people to a more attractive, a less daunting market with more tangible benefits. The hard work has been done, or arguably done, with the first level of participants. So those links, those relationships that need to be now, put in place more smoothly. That's a technological issue, isn't it?
Yep. Yeah. Thanks, Staffan. So, and you're exactly right. I think if you break down the challenge, right, whether it's regulatory costs, right, whether it's business costs, right, all of the penalties for not being efficient and not being able to mobilize that liquidity and access that liquidity and really make decisions in a fast and controlled way, the penalties are really high. Right. And those penalties are being enforced now, whether that, like we said, through regulatory pressures or through business pressures. And frankly, the velocity of the markets and the velocity of collateral and volatility and the speed at which change is happening is putting a lot of pressure on, our clients and the technology and the utilities and everyone out there to come up with solutions that can really help address these broad set of issues. Right. And I think sort of the example of a chain is a good one, right? Because I think 20 years ago, everyone could envision a chain that said, okay, it would be great. We should connect repo, we should connect derivatives, we should connect sec finance, we should connect our treasury departments, we should connect our operation departments. But until recently, really what that would have required was either a heavy lift of ripping out legacy systems, rebuilding, redesigning, possibly, accepting some compromises about, the cost versus what the new capabilities you could achieve through those heavy lifts would be. I think what's really changed maybe over the last 3 to 5 years is now that technology has evolved with the likes of us and also just the state of technology and the cost of technology that really says, okay, well, what are these links, right? So these links not only need to be strong and have the capabilities, but those links, unless they're connected and tightly coupled, really wouldn't be very efficient, right? You don't have a chain unless those links are strong, right? And so what we're seeing now in some of the capabilities we bring to bear are saying, like, whatever the strategy of the firm out there they want to achieve, there's technology now that doesn't have to require a rip out and replace. Right? It doesn't have to require a massive strategic analysis to say, hey, listen, I need to connect this data within my derivatives business to the data within my sec finance business, or I need to connect how you mobilize that collateral, right? So the idea is that there's steps and there's technology available to supplement and accelerate the tightness of those linkages, right? And those tightnesses can be everything from, do you have all of your legal agreements digitized, right? Are you digitized across your, sec finance, derivatives, tri-party, et cetera? Do you have all of your inventory and collateral tagged in the right manner to know that, well, Are there tenor differences, right? Are there statuses? Is the security settled? Is the security, trapped in a depot in some foreign entity, right? If it's trapped in a depot in a foreign entity and you need it in your North American entity, how are you accessing that in a way that can ensure that it's going to meet that liquidity requirement around the globe? So really, that's where we come to bear and try to help accelerate and build a lot of sort of trust in that process. You can achieve these sort of enhanced capabilities across liquidity, across collateral, across your funding, which is really the new dimension.
We're going to have to come back to that point in our second part of the conversation, because, as you said, you picked a number of examples which were from the international to the local to different spaces, but a couple of more. I'm putting myself in the shoes of a newcomer to this space, and I don't want to be daunted anymore. So I'm going to come back, but I want to give the floor now to David, because David, Wematch is much more than today than when it started in securities financing. I mean, indeed, you can tell us a little bit more about what you're doing. And I'm going to say something maybe a bit controversial. At one point, I even got the feeling that you almost thought, okay, this is not ready for me to expand the absolutely brilliant concept of Wematch, and let's go and have a look at other underlying my interpretation. And I would argue that you've done as well in swaps and in other spaces, and you've done in sec lending. But is the space now, a few years later, friendly? Is that chain something that makes you think, wow, let's forget boring swaps and TRS, dark that is, but let's come back into good old securities financing, securities lending, financing. What's it called now? There's securities financing. There we go.
Thank
David,
you,
the floor is yours.
Okay. So a couple of comments. First of all, I'm deeply convinced that total return swaps are really very, very similar to sec lending or repo. So for me, the equity financing embraces both the physical and the synthetic side of the business. So compared to Grant, obviously, we are not 20 years old, so we are still not even teenagers. We're 5 years. So two things I will learn how I can for next time do to put my head on screen without cutting my logo. So that's for BG as well. So for BG, so we need to you will need to tell us how you do this, Grant. And we're still babies, but we talk, we cry, and we're a bit noisy. So yeah, I mean. Well, first of all, I think we need to come back to the user. Okay, the user for us. I mean, basically, we talk mainly to traders, and I think the traders of 2021 or 2022 are fundamentally completely different from what they were doing back in 2001. Or I was a trader in 2001, and when I talk to the users today, their understanding of capital costs, of balance sheets, of liquidity ratios, of the impact of what they are doing at the level of the bank is huge, and that means that their expectations and their attention to the workflow has dramatically changed. I mean, 20 years ago, lending securities was very easy. You had stocks, you could lend them, and you didn't really bother about the collateral. You didn't really bother about the maturity. You didn't really bother about resets. I mean, that was pretty easy, and you could do it under a form of a stock loan or a TRS. It was exactly the same. So the business has changed a lot, and we can see today that the traders we're talking to are very, very versed, and they understand extremely well whether what it means for them to lend securities physically and very vanilla under the form of a stock loan, a contract, do the same trade under the form of a TRS, do the same trade potentially under the form of a single stock future, build tomorrow when the product is ready a basket TRF. So the reason why we are cross-asset, Gab, to answer your comment, is really because we believe, offering the spectrum of all those products to the traders is extremely important. And one of our USP today is because is clearly the ability for the traders to get access to not only the product, but the market color as well on all those products, and being able to compare like for like what it means to trade a stock loan, a TRS, a TRF, or a repo. So I think it's extremely important. Now, talking about the workflow, clearly, compared to our initial, let's say, approach, which was to really focus on matching and on matching liquidity, I think we came to the conclusion that the traders were really looking after the workflow, lifecycle management, ability to efficiently manage their collateral, the velocity of the collateral as well, making sure that they can move collateral from one bucket to another one easily, from one product to another one easily, to have their lists of shorts and longs being optimized in multiple asset classes and dynamically. So that kind of challenges that we've been asked to look at has been a real success, because I mean we decided to dedicate most of our capex and our funding. You talked about the funding into increasing the efficiency of the workflow for all equity financing products, and not looking only at stock lending, because we know that I mean the current providers have been doing a fantastic job over the last 20 years, and we've been looking at what was missing a little bit in the landscape, and what we've done on TRS is today becoming a market solution, and we're super proud of it, and it was clearly a kind of a gap before we started to look at it, and it gave ideas to our clients as well. We are now we're going to be launching next week a full solution on ETF synthetic, which is going to be a new I would say a solution to optimize collateral and the way primes are hedging their ETF synthetic positions under the same kind of leveraging on the developments we made on the TRS kind of D2D or D2C business. And I think this is going to be very useful for the clients, because they will be able to plug this new brick into the journey to try to holistically and overall optimize the velocity of collateral across multiple buckets.
So, thank you very much for that, David. And I must say, every time, even if it's on a yearly basis, there are a lot of exciting things happening in your company, and it's always well thought through. It brings us back to Staffan again. So Staffan, you now have a very, very large remit, which goes beyond the trading side. When you're talking about a peer-to-peer, you're looking at quite a long horizontal chain in terms of how it covers, and arguably an interaction with quite a number of other spaces as well. So let's go back to that. This space is less daunting. So we've heard for sure that we're going to hear a little bit more about. There's more technology, there's more solutions, there's more stuff that's worked with other formal shapes of a profile of actors. But you're offering a service now which is extremely ambitious. So maybe we can hear a little bit more about what you're expecting or hoping to achieve in the next couple of months.
Yeah, absolutely. And what we all are working on is given the ability to not only do the order, but also do complete production in behind. So if you go to a restaurant, you do expect to be ordered, but you also expect the restaurant to have a kitchen and a supply chain and all that side. So from that perspective, what is important for us to have that chain of functions that goes from front to back, and to be able to through the funding side of our business to do the trade, being it direct, being sponsored, being peer-to-peer side on the funding side, and on the collateral side, what we're then picking up is the post-trade of that. And with that comes the ability to optimize your inventory. Now, we also need to keep in mind optimization is something that is completely different from different organizations. And it's I wouldn't say opposite, but a buy-side optimization and a sell-side optimization. They're completely different views at looking at that. Buy-side, but by definition, are long assets. A question what we need to look for. Then typically looking more for optimizing the liquidity side. They don't have to worry that much on the capital optimization, but the counterparty has the capital constraints that they need to consider. So optimization is one of the aspects we're looking at across how they're utilizing the asset to achieve that liquidity once the trade is done. Entry points, be able to the market is another one. We're also looking at how we can help and work with firms to transform assets within the capabilities that we have within State Street, and how to transform an asset from a fixed income equities, etc., or a straightforward stock loan, and how to collateralize that process. So there's a number of different functions that are out there, making sure that the asset and the cash is available for margining of the derivatives transactions that right now is pulling a lot of firms into it. I have to say that the buy side challenge is not necessarily sourcing the asset for the UMR rules; it's more deploying them in a workflow side there. But there will be other transformation needs. If you're looking at the derivatives regulation on the VMs or the VM side, there you definitely have a draw on cash that need to be accessed to the market, and for the participant to access market and that cash market in a different way. So it is quite a daunting task ahead. It's also quite fun to build the business in this new environment. So again, the way that we are looking at building these functions, have built many of these functions already, is with partnership with the fintech, partnership with building things. So we are getting help with a number of different firms, including Transcend, and building some of that workflow and optimization and utilizing that. We are getting help with other aspects, optimizing it and assets and calculating exposures. And these components are now, in this market environment, easier to get hands-on access to, connect them get together, and come up to the market with a solution and the time to market with a solution that wasn't possible, say, 10 years ago, where everything of these in firms we've been working over the years were pretty much built in-house. There are far more fintech vendors out there that helps us to build these solutions to achieve that liquidity menu to our clients.
That is a very interesting point. And when we started this conversation or the prep calls, I hadn't realized how advanced things had gone since I was looking at things. And I think as you, Staffan, cracked a bad joke about the whole peer-to-peer experience that I'd had in the past. I have a long memory. So we bring up the fact that, as David said, that the trader today is more sophisticated than he was a couple of years back, and we're talking about the sophisticated end of the market. No disrespect, one who does that for a living on a daily basis. We mentioned that without the tools from the fintechs and without the tools from effectively the execution side or the platforms moving forward, then effectively you can't move very forward. So Grant, you guys have been around again, I'm going to say a long time. What Staffan is doing is opening up a complete segment, or a massive segment, of direct participants for you, I imagine.
I mean, potentially, yeah. I mean, absolutely. That's what we hope to see. I mean, we want to encourage liquidity, and look, let's be clear. Whether that comes through on SBL, whether it's repo, whether it's TRS, we need to reduce latency. Yeah, so we look at, I mean, our existing product. Yeah, clearly. I mean, historically, we started enabling people to basically find and source liquidity in the SBL market, but that grew and changed very quickly. And it was EquiLend shows what the name was. It was focused on equities. We're hugely active in the fixed income market, and that grows more and more as we put, again, CSDR, pull that back in as a point. People need centralized liquidity, yeah, and that's really important for us. We trade in equivalent of about 60,000 trades a day, about $100 billion of liquidity just purely across, and I would just say the securities finance market broadly. But the importance of that is being able to do it without latency, ensure that you are able to manage your post-trade connectivity more than anything else, so that if you do trade, the thing settles more than anything. Yeah. So reduce that friction, enable the people to be able to trade across the different permutations of a transaction they want to trade, whether it be SBL, whether it be TRS, whether it be because it's an upgrade, downgrade transaction. Like David said, it's actually the trade is a substitution of an asset versus either cash or another asset. We do it under different legal structures, of course, and that has different requirements from a technology point of view. Making that simple and reducing that frictional process means we can enable clients such as Staffan's clients to enter this market and find access to that liquidity. I think you have to think about the way people access markets as well. So is it discrete? Is it an order book? Is it open market? And I mean, look, majority of the platforms, and certainly ones we operate, are discrete request for quotes. Yeah, so you're discrete in what you do. You can trade with the people that you can trade with, because the reality is, and when you're talking about clients that Staffan's looking at, there's different credit exposures, there's different risk parameters around who you're willing to trade with. And you have to think about those things as you show liquidity to the market, at what price, what margins, what collateral parameters, and they are different. So enabling people to do either discrete or direct request for quotes across all the different transaction types, enable that to different client types as well, and show them an easy way in. I've got a banner behind it, it says EquiLend Inspire, but the point is you need to book the trade, you need to find the liquidity, you need to be able to settle it, and you need to do the reg reporting component with it as well. It is relatively complex, but we can break it down, we can make it easy for people to access, and that means we can enable the market. And I think that's the key points to that. It is complicated, but really it's an asset versus of an asset or cash, and it's managing that risk, which is the most important component of that. And that's where, you know, partners such as Transcend come in, help people understand. Let's face it, way back when, and we talked about before this call, that I used to work at Bank of New York with Staffan a long time ago, and there was a lot of paper collateral schedules. That can't be the future, and it isn't, thankfully, anymore. Yeah, digitization of everything is the most important parameter, and that's where people like Transcend can read and interpret and help partners that work with them to optimize if they deem it to be optimization. And optimization means so many things to different people, but it helps them manage and it helps them understand where their obligations lie. Because back in 2008, it wasn't necessarily the same thing.
It's thank you for that, Grant. Yeah, we're using words that we didn't use, or they had very different meanings from our world into other worlds. I must say I'm happy to still be alive and hear that in the course of a panel on liquidity in sec lending, we're talking about latency. We were on the days when every trade was an exception, and you kept it going for as long as you could because it sort of worked. Now we're talking about latency, which is great. Automation is, as you said, means a lot of things to everybody. But once it's there and it's sellable, it's obviously something that you can point at and bring things going. Before I come to you, BJ, we've got to, you just need to sit back here and enjoy everybody selling what you're doing. But I have a question, and I'm gonna read it. I'm gonna put it through maybe to you, Grant, and I'm gonna read it with quote unquote, so no one thinks it's me being funny or trying to, as my wife would say. Technology is big enabler of automated interdeal liquidity, which makes me think this could be my wife actually sending the question. Anyhow, go again. Technology is big enabler of automated interdeal liquidity. Service disruptions translate into immediate stress and displacement of flows into agency programs. Here's a question for you, Grant. Do regulators need to focus on the systemic importance of these platforms?
Oh,
David,
big question.
This one.
Big question.
I was going to ring a friend.
Let me start. So look, I mean, yeah, regulators need to have awareness of how important these platforms are. I mean, look, we're regulated, let's be clear, across all of our platforms, across all of our regions. And that's incredibly important that regulators understand as we launch into different products, into whether it be because we're going through Ireland and the CBI because that's our Brexit location, or it's in the US or in Asia. They do need to understand what we're doing, how we do it, how robust our platforms are. What's our disaster recovery programs? I mean, look, we've just gone, and it feels like we live this life anyway. Yeah, so we live COVID, and we work from home partly. We work in the office. The systems operate. Yeah, and it shows that we had one of our biggest days as COVID hit. Huge volumes. People doing it from home. So technology is robust. Regulators need to understand how that's transacted and managed. But yeah, they should be aware. We work closely with them. They are aware of what we're doing and how we're doing it, but they should be closely monitoring these markets.
I totally agree with you, Grant, and I think if you look at the beginning of it, I mean, regulators have been pushing as well. The development of all those platforms, because I mean, all those new regulation about best execution, price discovery, about making sure that orders are being treated fairly, about reporting, the complexity of reporting. has been a blessing for guys like us. Let's be honest. And for me, yeah, the second step is that the regulators are going to be looking more and more at how the markets are being organized. The platforms are being more and more important in the way those workflows are being digitized. So it's not a threat, it's not a risk, it's going to happen, and it's a blessing, and we are welcoming regulators looking at what we're doing into more details to ensure that there is that everything is done in the right way, that everything is reported in the right way, and that we are contributing to the way the regulators want the market to evolve. So for me, it's a given, and it's obvious.
So those regulators listening to this panel, you can sleep. Staffan, you might have a little different angle on this one, maybe.
I do a different angle on this one. There is a concentration risk to some degree. Yes, the regulator looking at that side, but also we have to remember the liquidity in the market. You go to a marketplace with all the participants are. So for an efficient market, you need centralization to have the quotes going into the market. But equally, there need to be ways to diversify risk. So if you look at infrastructure settlement, post-trade, and other things as well, not just trading, there is an argument for the need for diversify and have options. And what we're looking at the market, what I mentioned before on the 2019 occurrence, if you look at the ecosystem from the participant perspective, we think we need diversification in participants. If you look from a service provider, yes, we're greater more diversity in the service provider perspective. But also the interconnectivity and interoperability is also important to strengthen the ecosystem, so that every single participant in the industry has options. And if one part falls down, you can go to the next step. It's always a question of having a plan B, plan C, plan D, etc., and working through your options. You never back yourself to a single option to any business management.
I think too, just if I could add to that, clearly I think what you're touching on, Staffan, is that information sharing, right, has to be a key component between whether it's within the market or within a particular firm. But and I want to tie this back maybe to something David said earlier around the sophistication of the decision making, right? So traders are looking at more complex set of factors than they may have been 10, 20 years ago. All the firms are looking at more complexity, right? And oftentimes what we're seeing a little bit is that we'll call it the decision making capabilities, or what should be done sometimes lapse how you can get it done, right? And what do I mean by that is there's, whether it's, a desk says, well, if I do these 50 things, I could optimize my funding, my collateral, my liquidity, I could reduce my risk, I could take down my counterparty credit. Well, do you have the mechanisms to make that happen in real time, so that if something were to occur, if we did get a risk spike, or you did want to be more efficient on a day in and day out basis, do you have the booking model, the STP, the execution services to actually facilitate those more sophisticated decision making, right? And I think, a lot of times what gets overlooked is the actual operationalizing and the sort of the capacity on the back end to facilitate some of these, whether it's during a risk spike or just on a BAU basis, some of these more sophisticated problems that are trying to get solved for. So I think the operational component.
Well, actually, that's a very interesting point, because the second angle of liquidity and the challenges or drivers even of liquidity that we discussed was effectively the comment that David made earlier, which is, when we started, we looked at the trade or liquidity, and then we sort of looked at the process or the workflow afterwards. Today, you describe the sort of questions an existing participant or new participant might ask himself, and that is about workflow. But you've got drivers now in front of you. You've got the Grants and you've got the Davids saying, listen, talk, or indeed Staffan and Staffan's customers saying, talk to the likes of BJ, Raj, and I had to mention Raj a couple of times, and a few others. And I do it with a lot of pleasure, Raj, by the way. Third time, yeah. And but you've got those drivers now, and so you don't have to really push anything other than say, right, I can bring you the solution that enables you to actually be active in this space. Are we there already? Are we getting there, or are we still talking about, you know, a few new participants, a few new. But I'll ask that to everybody. I'll start with you, BJ.
I think we're there. I think it's just really a matter of, you know, what's that? Where do you want to start? And we use the term "walk before you run, before you fly," right? And I think, you know, folks really have to be able to articulate where they want to get to and how are they going to tackle, you know, whatever sequence it might be in terms of the value add, right? So do they want to tackle, you know, coordinating across their businesses first? Do they want to tackle getting their internal reference data in a good place so that they're just have a common taxonomy both internally and externally, so they can look at their risks, whether centrally on a holistic, you know, easy basis? So it's really coming up with that strategy, but the technology's there, right? I think, you know, in the industry, whether it's, you know, obviously folks like companies like Transcend, or whether it's industry efforts, you know, whether that's, you know, ISDAs or other things trying to harmonize sort of legal terms and sort of APIs getting built out at third parties or utilities, you know, I think largely speaking, the technology is there. It's just a matter of deciding how, you know, what that strategy is to craft that end state that they're looking at.
Well, just stepping into before being rude, the technology is there. We're talking now a much wider target audience for everybody around this table, in fact, some of whom have deep pockets, some of whom have deep pockets but don't spend any money. I don't want to refer to any sale or buy side, but you can figure that one out yourself. So
no one wants to spend money.
Yeah, but some just, it's just impossible to get a penny out of them. But so yeah, it's great to say I got all these solutions. The business case is there. It's not theoretical, but we are going the other way around. We are saying, listen, invest first, and you'll get something out of the end. Is that a very naive question, or is that a fair question?
I think you can look at it more incrementally than that, right? I don't think you need to, you know, have the end state before you start realizing the benefits, right? And that's what I mean by crafting that strategy and saying, okay, you know, if I want to get to home, I got to cross first base, you know, to use a baseball analogy, I got to get to first, right? So defining what's first, what's second, what's third, you know, and then that's where your scalability ultimately comes into play. So you want those investments to have an ROI, right? I mean, nobody would do anything unless there was an ROI against any spend. But I think breaking the problem down into manageable bites, but with the eye towards, you know, listen, some of our clients want to organize around firm-wide central funding. Other of our clients say, listen, we just want to be able to optimize our CCP flows, right? Against one CCP or against 20. Or they may say, we just want to see our eligibility across all of our various legal agreements in one place. Or, you know, or we just want to see what's the tenor of our inventory. So I think, you know, it all depends on what your problem is, what your weak spot is. And listen, firms are going to do some of that on their own, and they're going to employ vendors and external technology to help with that. But it's really coming up with sort of what fits best for each of our clients.
And Staffan, I'm sure you have a role. That's maybe my background. Staffan, you have a role in educating these new participants, showing them the benefits and pointing them in the right direction in terms of how they can achieve this. Is that a fair assessment? Wait, you've been muted by. Everybody's muted.
I'm mute again. I'm still learning this new things, video conferencing. It's been a new occurrence to me to do this. No, but I'm still underline what BJ said beforehand. Is that it's important to have a strategy and end state in sight, and we have to recognize that market's shifting all the time. So things are going to move around. And they're going to take time to implement some of these things. And my point earlier is that the good thing with today's environment is that the components you can bring in, and you can build your infrastructure in a way that you have components and bring things in and take things out as things comes, partnering up with vendor solutions. You're also leveraging off all the investment vendors doing for the market from one particular side. So it's a great opportunity to partner with specialists and to build your architecture, your platform, your liquidity buffer. So I absolutely agree with what's said in the past. And that is, yes, the world is getting more complicated. We need more regulatory reporting, etc. But even that can be brought in. And one point that Grant mentioned earlier, that the benefit of some of this regulation is that the market is forcing us to be standardized in certain data elements, SFTR reporting, unintended consequences, that suddenly we're all playing around and we're still working with the same data set. And that makes that interconnectivity easier thing to do, and communications are easier to do as well, to help that post-trade work that need to be done for ensuring the market is liquid.
I'll add to that a little bit, because look, data that comes out of those components is really important. Yeah, so and there's elements of data like we already manage. Yeah, so giving transparency to market. But I think as we go forward, we're going to continue to evolve and learn. Yeah, so what we're going to learn post CSDR, we're going to learn who settles well. Where is that liquidity going to move? It's going to move to people that are good partners with you, who can settle your trade that you want to do. Yeah, that's reality. And people that behave badly, and that's the same as any market. It's not just securities finance. Bad actors, good actors will stand out more, and they'll be judged based on the impact, because it has a real cost applied to it. So look, I think data becomes stronger over time, and we have access to that information now. So it's really important to utilize and leverage that for the future.
So David, coming back to you on this one, because this is you mentioned your D2D business, but you also mentioned your D2C business. If I'm looking at the, as you said, the family of products, and now a more rational way than the sort of provocative way I used earlier, is there opportunities for you now to go to new class of customers because, quote unquote, the plumbing is ready or almost ready?
Yeah, of course. Of course it is. And is there opportunity to go to other client segments? Definitely yes. I mean, we are obviously, I mean, we started with, as you know, with the sell side, but we have now more and more buy side institutions onboarded into Wematch. And some of the clients are now asking us to look at whether we can potentially develop a money market product. So it opens the door as well to corporates, for example. And I think, it's not about client segment in the end. Once again, it's about the workflow, and it's about the product, and it's about the community you want to build around that workflow into that product. And if the community has to include, corporates, sovereign wealth funds, asset managers, central banks, I mean, we don't have any restriction. So for us, it's just only the beginning, and it's super exciting to be able to plug other client segments into the product, which is extremely nimble and very easy to use, in order to welcome more and multiple client segments into our solution and our workflow tools, of course.
Thank you, David. We have about 6-7 minutes left, and I'd like to bring the before we sort of conclude, bring it back really onto liquidity. And I know we didn't discuss this in the prep call, but is liquidity tangibly better? Are you guys making more money on the existing products in this space? Are the trades getting bigger? Are they getting longer? We in our call we barely mentioned the fact that this is an industry dominated at the two ends of the chain by some pretty powerful people. And I won't quote anybody, but I'll quote myself saying that inefficiencies actually yielded a lot of money. So have we seen those inefficiencies drop a little bit, and the liquidity being spread out amongst more people? And let me start with you, Grant, on that one.
I'll take myself off mute first. So how do we touch that? So I mean, look, liquidity for us, it continues to grow for our market, for standard SBL, etc. I think it's a very interesting market at this point in time. I think there's a lot of I said the word latency a bit, but latent inventory that sits on the sidelines because there's been lots of things going on in this market. Means there's a lot of liquidity out there. Yeah. So with central banks starting to unwind certain processes, that will have a huge effect on market. If interest rates go up, which they're not in the UK yet, but that will have a huge effect on market. So there is liquidity that is still very much sitting out there. There is more participants coming. and I think that's welcome because diversity of liquidity is incredibly important. Markets still grow as well into different regions, whether it be APAC or whether you look at Middle East, who are trying to start a derivatives market, and therefore that has a knock-on effect. Clearly, if you have a derivatives market, you need to hedge, and therefore that opens the avenues for other things that are going on in SBL, financing, etc. So look, liquidity is still incredibly strong in just standard securities finance, but there's capacity clearly to grow at this point in time, and that needs a risk-on environment to be, although the markets seem to continue to go up. There's been a number of events this year that have affected people's appetite for risk, and that has a knock-on effect on capacity and requirement in market. So I hope that answers your question, but that was my first stab at it.
No, but it's effectively, it's not a yes or no question. It's not a 5%. BJ, you go in there, you sell anything from a bicycle to a motorcycle to a car to a rocket. But even if you sell a bicycle, if at the end of the implementation there's no pesetas, that's the old currency they used to use in Sweden, then your customers aren't very happy, and your customers are probably your best salespeople. So what do you think?
So I think absolutely we've seen improvements in liquidity, and if you can think about, look again, optimization gets used in a lot of different contexts, and I think liquidity gets used in a lot of different ways as well. And whether you think about liquidity in terms of reducing unsecured funding usage, whether you think about liquidity as reducing buffers for intraday flows, whether you think about liquidity as accessing supply that otherwise may have been trapped due to operational reasons, whether it's seg optimization,
very artistic, BJ, very artistic.
So all of those from our seat, our clients, and even folks that aren't our clients that we just talked to, everyone is making strides towards improving their efficiencies and controls and their footprints around maximizing their sort of risk-adjusted shareholder returns, if you think about it, right? I mean, that liquidity is the grease that allows our clients to take more risk, to respond to market conditions. So, and really it's to scale. Like, there's a lot of sort of money being made out there by being smarter around how, like I said, not only just technology being employed, but how firms are organizing themselves around the decision-making cycle.
Thank you. We have 2 minutes left, so I'm gonna let David make a quick comment, and then Staffan, I want to hear your final thoughts on this one. David.
I'll be very quick. Yeah, I mean, we see liquidity increasing. I mean, we've never seen so high numbers as we have at the moment in what we're doing in the platform. So it's clearly a new record every week, and there's still a lot more to do. But we've talked a little bit about liquidity and about how it applies to our current market. And one point which is important as well is that in order to measure liquidity and to have an efficient liquidity, obviously competition is a given. So we need, in order to not only to give a price on an asset, but to be able to measure liquidity, to have competition within everything we're doing, and we are welcoming competition in any initiative we launch. So it's something that we really we welcome as a.
So I'll make sure I speak to everybody. Come and compete against Wematch.
Yeah.
Staffan, last word for you. The grey hair talks.
Very short. I mean, the market's obviously changed. We ran around the conferences years ago talking about revenue. Now we're talking about letter combination and ratios, etc. David quite well. Being a trader now on a desk is an equation. We need to present a quant to be able to understand everything happening. But despite that, the market is operating extremely well. There's working very well. The large scale dealer-to-dealer market is very strong. It is there. Some aspect needs complementary. There are capital constraints that make some trades unprofitable and they're falling off. But overall, definitely liquidity is in the market, and there are venues for various solutions that are coming out there. So I'm probably ending on a more positive note.
Well, I tell you what, I talk about a more positive note. I think I got the most positive panel of the lot. Oh, I don't know what happened with the technology here, but I think that's us in terms of perfect timing. Oh, this is Justin with his Justin, grow up, please. This is a serious conference here. I think that's us.
Yes. Well, on that note, Gabby, I'm here to call time on the session. It was very entertaining. I appreciate that very much, and very informative. So thank you to Gabby and the rest of the panel. And it was good to end on a positive note. Appreciate that.